Nilqakom għall-programm Flusek illum fl-assenza ta' Nicolette għandi miegħi llum il-Chief Executive tal-Bank of Valletta u flimkien miegħu ħanitkellmu dwar ir-riżultati finanzjarji tal-bank għas-sena li għaddiet. Welcome to the program, Mr. Hunkin. I was just telling the viewers that today we're going to be discussing the financial results of Bank of Valletta for 2021. So, Bank of Valletta reported a profit before tax for 2021 of 80.7 million, compared to 15.2 million in 2020. My first question is, are you happy with these results?
Thank you, Jesmond. As you might imagine, as a headline, it's a solid financial performance, and we're pleased to see some good recovery. I think there are some real positives in the performance. We've seen income come back very strongly post the COVID environment, where 2020 was obviously our most difficult year. The growth has come back in many areas to previous levels, and in some areas where we put particular focus, it's even got stronger. So very positive from those side of things. Last year was obviously also impacted by significant provisions, which aren't repeated this year. We may talk more about those later. On the negative side, we've had to invest quite extensively, and therefore you see our costs and one or two one-off costs are showing an increase in the cost line. But it's good to return to good profitability. The capital position has been strengthened. So yes, I'm pleased overall, but still work to do to keep progressing.
Good. So you mentioned already the main headlines on the results. So if we talk about the improved results, can you give us a bit more detail on the main results which drove this positive year in the light that COVID was still with us throughout 2021 and really even to some extent today?
Yeah. So we've seen good growth in our income lines, both in net interest income, which has been challenging because our deposit base continues to grow. And in a negative interest rate environment, those deposit balances are costing us quite heavily. But we saw continued growth in that space. But growth in lending volumes, excuse me, in both the business and retail side in terms of home loans, we saw good growth. And we put a particular focus into the investment side of the business, and we've seen good growth levels going back to previous highs in the commission levels earned in not just investments but in stockbroking and other related areas as well. So there's clearly been an economic recovery. The post-COVID situation has seen business volume start to restore, but we've put good focus into some key areas. The major variant for 2020 to 2021 is that in 2020 we took heavy provisions for credit losses, driven primarily by the COVID environment and also by regulatory changes on long outstanding non-performing loans. With some good economic recovery, we've seen specific assets improve. We measure it in terms of significant increase in credit risk. So there was an increase in 2020, but a recovery somewhat in 21. So although there's a number of moving parts in there, what we've seen is an avoidance of the 65 million we had, and actually some recovery as we've worked through historic assets. So the bottom line has benefited, the income line and the growth in terms of business growth has been encouraging.
Good. So you mentioned the net interest income, so the income side, which grew by 9.5 million in 2021. How was this achieved, and in the light of the possibility of rather when interest rates are likely to go up, how would this improve the financial results of the bank in the years ahead?
So on the lending side, we've seen good growth, and on the business side, our income grew by 4.5% to 5%, and on the retail side, the interest margin again grew by around about the 5% mark. So that's been driven by growth, So we've achieved growth in lending volumes, and as your book grows, you generate more net interest margin.
Yeah.
We've the margins on the business lending side have reduced slightly, so it's not a like for like in terms of the growth. But on the retail side, the margins have been relatively stable. So in terms of net interest margin from lending, that's been increasing. The deposit side, we've taken a number of steps trying to manage the impact of this negative interest.
Yeah.
Every bit of surplus liquidity we have has to be invested, and we can't invest at anything other than negative returns in the short term. So we have sought to mitigate this by changing our product pricing in some places, by trying to advise and help customers find better ways of investing and to generate a better return, hence the focus on the investment side of the business. In simple terms, if interest rates were to go up by 0.5%, that would increase our top line by somewhere in the region of 20 million. And that shows you the real impact of the negative interest rates on the bank.
Very good. You mentioned net interest income, which also increased by 7.3 million, which is nearly 10%, even exceeding the pre-pandemic levels. Is this, obviously this is a great achievement in itself. Was this the target, the projected target that you had? And do you feel, as you just mentioned, that this is likely to continue going forward?
So certainly growing the lending side of our business has been a particular focus for us. When the deposits are so much higher than your lending, you want to increase your lending closer to your deposits to become more efficient in terms of the balance sheet. So we certainly intend to continue driving our lending volumes to make sure we're more efficient in the processes and can capture our fair share of the marketplace. So I would hope to see continuing growth in the net interest margin in particular. It depends also on the deposit side, because if deposits deposits grew by nearly 900 million last year. Yes. So although the rate was similar to the lending, the sheer size of it means that deposits in absolute numbers are growing faster than our lending, and that's hurting the bank. So the net interest margin will depend in future to some extent on the rate at which they grow respectively, and also what happens in the economy and whether interest rates do move.
Okay. Obviously, on the other side, like all financial firms, total costs have increased significantly, nearly 15% by 25 million. What were the main reasons for this double-digit increase?
Again, there's a number of moving parts within the story. The headline number looks far worse than it actually is, because included within that number, we invested 23 million in moving the bank forward. So the investment side has gone into things like addressing regulatory issues, introducing new payment systems that we're forced to do as new deadlines come in, but also focused on the strategic investments that we've done in looking to streamline, automate processes, renovate our branches and so on. So if you strip back the 23 million, there were then a number of other one-off costs. We were fined 2.6 million by the FIEU. There was a scam last year that caught a number of our customers out, and we reimbursed to the tune of 1.4 million. And a few other items occurred were releases back in 2020 that didn't recur in 2021. So the last bit is the deposit guarantee scheme. Yep. So we grew deposits by 900 million or 1 billion. We have to pay the deposit compensation scheme to provide protection. That cost alone was an extra 5 million last year, which is beyond our control. When you strip all of those factors out, the actual growth in the costs was around about 3.5%. Which reflected investment in staff that we've been making in key areas, bringing in new people to address new technologies and so on, investing in training, and also the investments in IT that we're making, where as you've made the investment, you start to incur depreciation. But these things are necessary for us to invest to sustain the future of the bank.
You mentioned earlier the net release of 18.8 9 million compared to a net charge of 65.1 million in 2020. Can you explain to the viewers a bit what these figures really mean?
Yeah, sure. If we go back to 2020, there were two main elements. There are a whole load of moving parts, and in, when you raise provisions in banking, there are a number of models that look at the credit quality of your portfolio and drive model outputs in what happens. But we've seen one or two significant anomalies in that, and in 2020, the first was COVID. So with the uncertainty that COVID created, with uncertainty in particular sectors and industries, we prudently, and working closely with the board, we prudently raised provisions to reflect the increase in credit risk that was being seen. The second part was the regulators have introduced something whereby the longer a personal a loan is non-performing, they reduce the value of the collateral. So that meant that we had to raise provisions on debts which may have been fully secured, but where under regulatory requirements we needed to change that. So that was 240s in effect in 2020. They didn't repeat in 2021. We still had to raise more provisions for some of the legacy non-personal loans, but we did a lot of work to improve the collateral, to manage some of those non-performing debts. And net, there was, apart from other movements within it, we recovered around about 30 million of the provisions we raised in 2020. So what you saw, therefore, was a big one-off in 2020 and a slight reversal as the economy and the credit management situations have improved in 2021.
Thank you for now. Ħanaf namlu waqfa qasira reklami kunu ma namna ftit ieħor.